Okay, I realize there have been quite a few videos. This is a pretty extensive set of um, presentations discussing financial distress, but it is a very complicated topic. So let's see if we can bring this to a close and come to some conclusions about debt and how much debt a company should have, or at the very least, what are what's the thought process in deciding to change capital structure? So we've talked about this trade-off model, explains how companies should choose their structures to maximize values. The challenge is it doesn't seem to match reality. It doesn't match what really happens in practice. The management entrenchment theory basically says this is a theory that suggests you choose a structure to avoid the discipline of debt and maintain your own job security. So you minimize leverage to prevent the job loss that would come with the constraints and the financial distress that might be enjoyed, if you will, by the public itself, right? So management entrenchment says we should try to minimize debt if we possibly can. But let's think about a theory referred to as asymmetric information. And we're going to apply this in two places. Once here about with debt, and the other place we will apply this is with later with respect to some dividends in a later video. This is obviously a situation where we have unequal information. Managers have superior information compared to investors. And having said that, then, managers have an idea of what the true value of the company is. They certainly understand the strategic plans. They understand projects that are coming online. They have a better picture of future cash flows than anybody else. So there's something referred to as the credibility principle. This basically claims that one's self-interest are credible only if they're supported by actions that would be too costly to take if the claims were untrue, right? In other words, managers will not tell us falsehoods, right? They won't tell us lies because the cost of that falsehood is far too costly to their self-interest than the benefit that they may perceive, or any benefit that the company may, at least in the short term, get based on the information that they're providing us. So let's assume we have a large profitable project. We can't discuss it because of competitive reasons. One way to credibly communicate this positive information is to commit the company to some debt payments. If the information is true, the company's going to have no trouble making the debt payments. If it's false, the company's going to have trouble making the debt payments. So that distress is going to be very costly to the company. So the use of leverage is a way to signal information to investors. Thus, as a firm uses leverage as a way to convince investors that it has information that is positive, that the company is going to grow. And even if it can't give details, and that is actually the foundation of this idea of information signaling, right? We don't want them to tell us exactly what's going on. We just want a signal as to whether or not the future is going to be better or worse than today. So we have this company of the market value is either 100 million or 50 million, depending on success. We view the outcomes as equally likely, right? The Smith, one of the owners, right, one of the managers, has information that success is virtually certain. So with leverage of 25 million, or will leverage of 25 million make Smith's claims credible? What about 55 million, right? So again, the question is, if managers know it's certain, how can they give a signal to investors, to the shareholders, that this is a good thing and the value of the company is going to increase? So if leverage is substantially less than 50 million, right, then there's going to be no risk of financial distress regardless of the outcome, right? So as a result, there's no cost to leverage even if they don't have positive information. So leverage of 25 million wouldn't be enough to signal strength to the investors. However, leverage of 55 million is likely to be a credible signal. Again, if there's no positive information, there's a significant chance that they're going to face bankruptcy with this new debt. So they'd be unlikely to take on this amount of debt unless they are certain about the firm's prospect. So again, let's continue thinking about the process, right? Adverse selection. This is the idea that when buyers and sellers have different information, the average quality of assets in the market is going to differ from the average quality overall. In other words, if everybody has different information, we're going to see differences in the way people value assets. The Lemons principle says when a seller has private information about the buyer, a value of a good, buyers are going to discount that price they're willing to pay because they know that the seller knows the true value. And of course, you never would offer a value less than the value of a good, right? So again, the idea here is we're going to have this example, right? The classic selection is the used car market, right? If the seller has private information about the quality of the car, then his desire of the car to sell reveals the probability of low quality, right? Buyers are reluctant to buy except at heavily discounted prices. Again, if the seller is really pushing to get rid of this car, it might be an indication that the car has low quality, right? So the quality and prices of cars that are sold in the market are both low, right? Because high quality cars, owners are reluctant to sell them because they know buyers will think they're trying to sell a lemon and they're only going to offer a low price. So again, this idea of differences in information has an impact on what is available in the market to buy and then what is the price of that stuff in the market to buy. And the same thing then can be applied to the market of equity. If we offer a 70% stake in a company, he states that he's selling only because he wants to diversify. That's what he tells you. But you suspect that he might be able to sell such a large stake because he might be trying to cash out before some negative thing happens. So firms that sell new equity, obviously they have private information about the quality of their projects. However, because of this lemon principle, we're reluctant to believe their assessment of new projects, right? So therefore, managers who know their prospects are good won't want to sell new equity because investors are going to be wary about the sale of new assets. Only managers who know their companies have poor prospects are going to want to sell stock. So the lemon principle creates a cost for firms that need to raise capital from investors for new investments. If they try to issue equity investors are going to discount the price because they understand, or they have an inclination, I guess, that managers have bad information about the company. So how does this, what are the implications of this Lemons principle? Stock prices decline when equity issues are announced. Stock prices tend to rise prior to the announcement of an equity issue. Firms try to issue equity when information asymmetries are minimized. So right after an earnings announcement, when there's new information provided, asymmetric information is now minimized. So at that time, they may be willing to issue stock because the differences in information is ultimately minimized. So managers who perceive, again, just as a kind of a closing here, right? Managers who perceive that the firm's equity is underpriced are going to have a preference to fund investment with retained earnings or debt rather than equity. And of course, the converse is also true. If managers perceive the firm's equity is overpriced, they're going to prefer to issue equity as opposed to issuing debt to fund investments. So kind of let's work our way through this, right? If you think the stock price, if you own a stock and you think that the stock price is underpriced, right? That is, the price is way too low. You know that the true price is higher than that, right? Would you be willing to issue or to sell that stock? Of course, you wouldn't want to sell that stock because you think the value is higher. If you needed to gather funds instead of issuing stock, you would issue debt or use retained earnings. And vice versa is true if you think the stock price is too high. So this leads us to our final pieces of discussion with capital structure, which refers to the pecking order hypothesis. And this essentially says, look, managers have a process. They want to fund investments first using the profits of the company, right? From talking about the weighted average cost of capital, we know that internally generated capital using profits of the company is less expensive than new stock. It's certainly more convenient because we already have it. So in our pecking order of where to get money, the first place we go to is retained earnings. Then, if we still need more money, then we will borrow as much as we need to. And if we run out of available debt to borrow, we then, at the very end, as a last resort, will issue common stock. Now, the issue with this is it kind of blows the trade-off model out of the water because it really doesn't give us a clear prediction of how much debt equity we should have, right? So firms that have low leverage, right, they either have low leverage because they're unable to issue additional debt, or they're forced to rely on equity financing, or because they just don't have enough profitability to finance investments with profits themselves. So, this can drive us to illustrations of how companies finance separate from any other company, right? So a company is driven to finance based on their own circumstances rather than any kind of proposed formula such as the trade-off model. But let's think about how financing in general works, right? If you look at aggregate sources of financing and how they have changed over the years, right? You can see that from time to time, internal financing is the greatest amount of financing that's used. People use profits and retained earnings more than anything else. Debt, more than not, as actually is negative. In fact, since way back here in 1994, the actual issuance of equity is actually negative. So that means companies, instead of issuing stock, companies are more likely to be buying back stock, and that's shown some increasing trends over the last 25 years. So let's think a little bit about this process, right? There is a market timing view of capital structure. Again, basically says capital structure depends in part on market conditions. It has importance when you think about how a company reacts to the economy, to its industry, to its opportunities for investment. So the pecking order theory says, rule one, we're going to use internal financing first. This then brings into view the investment opportunities of the company and the dividends of the company. So how much of our earnings we pay out in dividends is going to affect how much or how well we can finance the companies through using profits. Rule 2, issue debt. And finally, if we need, as a last resort, we will issue new equity. So this pecking order theory, again, is at odds to the trade-off model. There's no target debt-equity ratio. Profitable firms may use less debt. Companies like financial stress, or financial slack. So companies are going to keep or maintain an ability to borrow just in case they don't have enough profits, and just in case they need a lot of money, they don't ultimately want to be forced to issue common stock. So let's see how this ultimately might affect our decisions. And the researcher Myers talks about asymmetric information to try to explain this pecking order theory, right? So the trade-off models, all the models we've talked about, have assumed that investors have homogeneous information. That is, there's symmetrical information. So let's assume we have a stock price of $19. We have 10,000 shares, but managers know that the true value is $21. So when other investors find out about the true value, of course, the stock is going to move to that value. Management finds a project has a $5,000 net present value, and it's going to cost $100,000. So let's think about a world with symmetrical information. If it's symmetrical, everybody knows the stock's worth $21. So they're going to have to issue 4,762 shares. So the new stock price is the original value plus the $100,000 that they gathered plus $5,000. Divide that by the total value of new shares. So the new stock price is $21.34. So in this case, the stock was sold at 21. Everybody knew it was worth 21, and everybody gained value. Now, when we're talking about everybody here, we're talking about the shareholders. Both the new shareholders, the ones that bought this new stock, and the old shareholders both gained value of 34 cents. But what if we have asymmetric information? Nobody knows the true value except for management. They issue stock, but now they're going to only get $19 per share. So now there's 52.63 is the number of shares. So now the new stock price is going to be $20.64. So before we go on, let's ask a very simple question. who do you work for? Do you work for today's shareholders, or do you work for tomorrow's shareholders? Or in this case, what we're talking about is the new shareholders that buy these 5,263 shares. In this case, we should not do this project, even though it has a positive net present value. The old shareholders lose 36 cents in value. Remember, management knows ahead of time that this company with this project is worth 21. But when they're done by issuing these stocks, the value's only $20.64. So they lose value. But the new shareholders gained value because they only paid $19 to buy the stock, and now it's worth $20.64. So if we could find more profitable projects, can that help us? So a more profitable project, let's just change the net present value to $20,000. Now the new price is $21.62. And now note that everybody wins. The old shareholders gain 62 cents, but the new shareholders gain $2.62. So again, even though the new shareholders gain, they actually gain much less than these new shareholders. So what does this imply? With asymmetric information, we should only issue stocks if we have a very profitable project that cannot be delayed or financed with debt, or if management thinks that stocks are overvalued. Because investors recognize this, right? And they're going to tend to mark down share price when firms issue shares. They see this as a bad signal. So this pecking order makes sense with asymmetric information. It pays to retain a large fraction of earnings. We need to keep the debt ratio down, and we need to maintain some reserve borrowing capacity. So pictorially, how does this seem to fit, right? Managers act in the best interest of existing shareholders, not new shareholders. Information asymmetry, that there is differences in information between managers and investors. So we can make some predictions about managerial behavior. We understand, or we assume, that managers are going to hold some financial slack so they don't have to issue stock. They're going to follow this pecking order. Equity will only be issued as a last resort. So the optimal capital structure depends on many things: market imperfections, taxes, financial distress, agency costs. And in the end, asymmetric information is going to have a huge influence on the debt structure and the financing choices that managers make. So in the end, the question that we started this capital structure process with was, how much should the company borrow? And the answer to that is very complicated. This is why many companies, even within the same industry, are going to have vastly different borrowing choices. They are affected by different tax levels, different financial distress points, information levels, investment opportunities, profitability of the company. All of these things come into play when you think about the borrowing and the gathering of funds that companies go through. So I know it's been a very long set of videos on financial distress, but I think in the end, we've muddied the water appropriately. We know that it's very difficult to determine from the outside why a company is financing the way it does. We can only hope that managers will attempt to maximize the value of the firm based on their choices of investing and their choices of gathering funds for those investments.